So next what we're about to do is continue the actual process. Now at this level I want you guys to understand that this accounting information stuff is a process. It's a cyclical process and it's rudimentary in the fact that you have steps. And so basically throughout a period what you're doing is you're going from the recording phase to the reporting phase. Okay, because remember that's ideally what the process does. And so recording comes first. You have these different activities, these different transactions that occur, and every day you have to take account for them. You have to keep track of them. And so you basically what you're doing is the days go by, every day as those transactions occur, you're recording them into your journal and you're posting that information into your ledger. Now, at the end of a particular period, it doesn't matter relatively what period it is, but at the end of a particular measurement period, it could be a month, it could be a year, it could be a quarter. Naturally, businesses do operate in months, years, and quarters, or months, quarters, and years. And when you want to report this information to the public, then it's time to generate those reports. Understand this, guys. Financial accounting affects the public because the information goes to them. But what information is exactly going to them is the reports. Those financial statements that we spoke of earlier. The 4 financial statements are the information that is distributed to the public. We have no access to their journals and their ledgers. But through the journal and ledgers, they create reports, and that's what we have access to. And so now I'm about to tie in the loose knots and kind of go from the recording phase to the reporting phase. Okay? So first things first. What we're going to do here is we're going to calculate ending balances. We're going to calculate ending balances. But before we go into calculating the ending balances, I want to give you a quick definition. You're not going to get a lot of them from me, but you're going to get this one. Normal balance. What is the definition of a normal balance? Normal balance is basically the side in which the account increases, period. Side in which the account increases. And so you could use the all-clear system to understand a normal balance. Anything that's on the all side, normal balance will be a debit. Anything that's on the clear side, normal balance will be a credit. So as you can see, the normal balance for dividends are debits. Normal balance for common stocks are credits. Normal balance for lands are debits. And we know why? Because it falls into the all-clear category. Okay? Now, why do they call it a normal balance? Because that's going to be the side that the ending balance normally sits on. So when I say ending balance, what is an ending balance? I'll show you. At the end of a reporting period, you have several transactions that may affect one particular account. Let's look at service revenue. So far we've had 3 transactions that actually affected this account. How do you know? 1, 2, 3. But it's time to do the reporting. And so at the end of the day, we have to find out what's the total value of this particular account. We have to do that. So we have to summarize that. And so how do you calculate your ending balances? Very easy. You add up the debit side. You mentally remember that number. You add up the credit side. You mentally remember that number. You subtract the 2 numbers that you mentally remembered. And whatever that balance is, goes on the side that had the largest amount. For example, let's look at this accounts receivable. The accounts receivable has a debit amount total of $3,000, but a credit amount total of $2,000. So technically we've already added both sides. We have $3,000 on one side, $2,000 on the other. The next step would be to subtract the 2. So we subtract the 2 and we get $1,000. Now, the only other problem you have is where is the $1,000 going? The $1,000 is gone on the side that has the highest amount, $3,000. So we're going to put $1,000 under there. We separate the ending balance from the regular transactions by putting a line on top. And that's going to give us $1,000. So at the end of this period, our accounts receivable balance is $1,000. Hopefully you guys can see that. Okay. So what I'm going to do is calculate the ending balances for all the rest of these quickly. So dividends, we have $5,000. Nothing was on that account, so that gives us $5,000. Common stock, we have $30,000 plus $18,000. That gives us $48,000. I need to get my phone ready because I'm probably going to have to use calculations in a second. We have land. Nothing was affected on the credit side, so the normal balance, the ending balance stays at $20,000. We have supplies. That gives us an ending balance of $500. Nothing was affected on it on the credit side. Service revenue, nothing on the debit side, but of course we need to add that up. So what is that? 3 plus 2 is $5,000 plus another $5,500. That gives us $10,500. And let's see, where's my calculator? Okay, we have accounts payable. What's the rule? You add up your left side, debit side, which gives us 300. You add up the right side, which gives us 5. We subtract the 2, that's 200. Where does the 200 go? The highest number that had the amount, which is a 5, so it has a normal balance of 200. We go to rent expense. Nothing was affected on rent expense on the credit side, so that stays 2,000. And we're going to save cash for last because I'm going to have to calculate it. We have notes payable down there. Notes payable is going to stay the same at $60,000. We didn't pay on it. And we have furniture that's sitting here at $18,000. So we're going to add it down there, and obviously building $60,000. So thus far we've calculated all our normal balances. And so now what we can do before we go to the actual reports, those actual 4 financial statements, is we could develop what we call a trial balance.